What's up, Walker?
What's up, man? How you doing, Ryan?
I was just saying, I'm so excited, man. Like, I was thinking about when you and I did the last interview 4 years ago, I forgot to do the intro, and I had to do the intro after a very long holiday party with a bunch of YEC entrepreneurs, and I had to get up at like 6 and do the recording in the basement with like a blanket over my head so that way it sounded quiet. So I very much remember the last time you were on the podcast because of how ridiculous I had to do that intro. But I was digressing. Let's start with the people not familiar with your background. I mean, you got the Buy Then Build book out. You've kind of been creating this category of an acquisition entrepreneur. But why don't you just kind of give us the Cliff Note bio to how you got to where you are today and what you're doing?
I kind of joke that I basically started acquiring existing businesses because I'm a terrible entrepreneur, right? I tried to start a business and it was going really well, completely failed. Next time, got into a top 10 accelerator, recruited a Microsoft executive to be the CEO, oversubscribed the capital raise, and 18 months later, we were totally out of cash. Like every single time I was trying to start from scratch, like it just ended, in flames. And the thing is when we go into this, we know that it's like, tough, right? Like we're sort of, but there's kind of like a Han Solo moment where you're like, don't tell me the odds, but like I just look at the numbers. I'm like, startups are like punishment for people that don't understand statistics, right? And I'm here in St. Louis. Okay, I'm here in St. Louis, and I'm looking around, and I'm like, I don't live in Silicon Valley. Like all of the people who live on like the expensive houses in town, like they just own like 6 subways or like this little manufacturing plant that makes like circuit breakers, whatever it is, like it's just like like things like like Listerine come from St. Louis, like really just like so I was like there's got to be a way to like I know I can like get a bank loan to like buy an existing company, I just don't know how to do it, right? So in 2004 I went out and tried to buy my first company. It took me until 2006. Okay, then I ran a company for 7 years, had an exit, used all the cash to go out and buy 6 more companies. So between 2006 and 2016, during that 10-year stint, I actually acquired 7 companies. And then during that time, kind of similar to you, like I just wanted to get really smart about the private capital markets because like your MBA does not tell you anything about this like sub $25 million private capital market. So along the way, I became a certified M&A advisor, certified M&A professional, M&A master intermediary, certified exit planning advisor, just all the things, right? In a way to try to be like, how do I understand my blind spots and what I don't know? And along the way, I kind of started getting recruited. I proactively reached out to Quiet Light, where I still work, I guess you could say part-time, just to stay involved in transactions that I'm not acquiring or selling. And then, of course, I do a lot of investing and deal in businesses that I'm not operating. So currently I run also a coaching program called the Acquisition Lab. We've got about 300 buyers that we try to help find and buy a business. And the point is that I was doing the numbers the other day and I realized I just passed 100 transactions, either myself or consulting. Way. Yeah.
Congratulations,
and I was like,
man.
That's kind of like a milestone or whatever. Yeah.
Heck yeah.
And I didn't mention Buy Then Build. So I spent 4.5 years kind of writing Buy Then Build as I was going through this. I went through like 6 drafts and launched that in 2018. And sales were okay until I was on this podcast. And then because I was on this podcast, sales blew up. And
there you go. And let me guess, you haven't even written a review for us. No, I'm just kidding. I love it. That's awesome, man.
We'll like meet somebody and they'll be like, oh my God, or whatever. And my kids are like, Dad, are you famous? And I'm like, I'm really, really famous to a really small group of people.
Exactly. It's the goldfish in the little pond. I love it, man. No, but it's honestly, man, like I'm trying to think, and we're going to unpack a lot of this, but like I think it's so fascinating watching your growth, and it's the wave you even talk about in the last couple of chapters or the last chapter of the book, right? And you're like, there was the thinking, or it was the Robert Kiyosaki, the Rich Dad Poor Dad. A lot of real estate over the years, and that makes a lot of sense as real estate's boomed for the last 30 some years. But like these companies, and you're talking about it, and you're like, this is ridiculous, this opportunity. But I've watched the wave because you started, talking about this category, And I handed your book out, I don't know to how many people. And then all of a sudden it's like, now there's search funds. The amount of chatter around this has exponentially grown, but you were easily at the forefront of that, and not just some BS thought leader that's talking about what should be done. You have gone through the hard stuff. You and I covered that on the last one. And I think it's just super fascinating that you figure out a way to help educate the market. Cause like, there's just, I don't know if like mathematically, you talk about stats, the amount of baby boomers that are going to be transitioning, I don't know if there's enough buyers, period. Like there's going to have to be.
If you run the numbers, there's not enough buyers. I mean, it doesn't feel like that, right? I mean, but yeah, I mean, there's baby boomers own more companies than any other generation in history, and they all need to retire by the end of the decade. It's, the number's $10 trillion in business value. And, it's like 96% of them are, sub $25 million company, right?
Which, and you think about, and this is as we're kind of get into, go for it.
No, I was going to say it's more like 98.5% is less than sub 25 million. Sorry, I had my numbers wrong there.
But it is ridiculous. I talk about the stats all the time from the U.S. Census Bureau. Where like out of the 6 million privately held companies, they employ like 120 million Americans, and like 5.6 million of those companies are sub 5 million.
So Ryan, no one's ever said this. Okay, no one's ever said this, but I have a theory, which is, think about this for a minute. Like the big driver, the little thing that made the big difference, okay, in the last like 5-6 years is the SBA changed what they were funding and at what levels. Okay, and they basically said, look, banks, we're going to allow Ryan and Walker here to go out and acquire whatever business they want, as long as they give us a personal guarantee. We don't care about the collateral. We don't care what the balance sheet looks like. That's their call. We're just going to fund it. Okay. The SBA is a federal government. It's not.
It's an agency in the government. Yeah, it's
agency,
federal,
right?
It's like Fannie Mae, Freddie Mac, right? Like where they're helping deploy the capital to get it out.
But like, why on earth would the government get involved with like small acquisitions? And the answer is because it's like 49% of the entire economy is owned by these baby boomer owned businesses.
It's not all Peloton and Apple, Walker. Come on, man. I know, it's so crazy. You're right. No, I agree with you, man. And the banks guarantee, or the SBA guarantees, what is it, 70% of the loan or something? It's something so ridiculous where it should make it pretty easy.
Yeah, it changes in the background. I think it's 75% of the collateral to the banks, right?
Okay. Okay. Yeah. Anyway, so let's dive into what is an acquisition entrepreneur, and there's a lot of different flavors. So we can kind of take this in a couple different routes, and I'll keep us on track. Hopefully, is that maybe talk about the different flavors, and then we'll talk about like how they're finding the companies, what they want from them, and how that kind of how the overall process works. But let's start with kind of like the flavors of acquisition entrepreneurs.
Love it. Okay. So at the macro level, there's sort of like 3 categories. Okay. And the first one would be, buy then build was sort of the introduction of, hey, we know that like companies out there sort of grow through acquisition. Okay. But maybe instead of starting from scratch, you can just like leave your corporate job and go buy a business so that you have your own asset that you're in control of, that you get to own. Okay. Mm-hmm. And so acquisition entrepreneurship at the most fundamental level is really just saying like an individual who's looking to buy a company to own and operate. Okay. Mm-hmm. So anyone who's listening to this, that's a potential seller, right? That means you're an operator, and they're basically just trying to get out of corporate America and become you. Right. Mm-hmm. And they don't have the kahunas to start from scratch, or they've got the golden handcuffs and they need cash flow or whatever their reasoning is, ownership.
Can I add a little commentary on that too, Walker? Because like I would tell everybody that I'm always having to describe your category that you've created, because not a lot of people understand. I'm like, in Minnesota, we've got 19 public companies. There's always like the 3M or Best Buy or Target exec that's like, hey, I either got my 401k, I got some money, and they want to go buy a business. But one thing that what we continuously talk about is there's the job, which is the W-2 payroll, and then there's the asset. And this person's essentially wanting to do both at the same time to get in there and have the job and grow that asset.
I call it active investing. I mean, like passive investing is the thing that gets all the click, all the clickbait on Facebook.
Yeah. Hey, do it the hard way. No.
yeah. Well, that's kind of it, right?
Right.
But like, if you think about real estate, people sort of, idolize real estate as a passive investment. It's like, oh, I can own this thing and like not put much time into it and it just pays me out, right? But the thing is that the reason it's passive is because the appreciation value is just going to grow at about 2% a year for a decade or 2 decades or whatever it is, right? But if it's an active invest, if you could spend more time on that building and all of a sudden it would appreciate, 10x its value over the next 5 years, it becomes really interesting, right? But people don't think of it like that. We think of the only things that can, 10x in value would be like your startup or whatever. Well, if you buy a business and put your time into it, right? Not only are you getting that existing cash flow, but the appreciation value is completely correlated to the time and effort that you put in. So, I love it. And that's what we like as entrepreneurs, right? We want to grow things.
And so what were the other 2 categories?
So search funds and then frankly, just active owners, right? So going back to the first one for just a minute, in the acquisition lab, every time we run a cohort, there's always like 1 or 2 people in it that the best acquisition entrepreneur is the sort of like, I grew a company, I started from scratch, I ran it for X amount of years, and I just exited like 6 months ago. I am not doing that again. I'm going to buy something that's already kind of going. So they know how to operate. They know how to operate successfully. And they're like, oh my God, that startup part is just so hard. And you talk to people and it's like, yeah, if I knew how hard it was, I wouldn't have started a business. Like, it's just that
and
hard.
By the way, I'm just going to say that for me from Arcona, if I would have known that, but after we saw this, you just took the words out of my mouth, man. Amen to that.
Right? It's hard. I mean, it's really hard. And so, And so the thing is like, the flip side of that coin is going to be just existing owners of small businesses, right? So again, I'm kind of defining this as the sub $25 million market. We can talk about individuals buying bigger companies if we want to.
Concepts all apply, I think. I mean, it's...
Yeah. I recently got cleared for a loan over $100 million in order to take out this big company. It didn't go through, but like you can apply all of these like this, right?
Yeah, so the zeros are just the commas just in different places.
Exactly. So if you've got a company where you're doing between 1 and 10 million of revenue, you're going to be growing organically, but frankly, the fastest way to grow is going to be through acquisition, right? So there's only 2 ways to grow a business: innovation and acquisition. That's it. Okay. And so the thing is acquisition is always a viable option. A good friend of mine had this great startup that he was doing, and it was off to the races. Things were going well. He said, Walker, I didn't read your book at first because like I know you, and like I read it and it blew my mind. And now he went out and did 2 acquisitions within 12 months. And now his valuation is north of 30 million. They're raising a Series A north of 30 million for the next hiring round, right? So he just went from,
nothing.
Like,
nothing is.
Like a sub $5 million valuation to a $30 million valuation just by growing through acquisition. Okay. And it was a very high growth startup kind of approach to the buy then build model. But anyone out there that's running a business should definitely be considering this as an option. Okay. So you've got someone who doesn't have a business who wants to buy it, or you have someone who has a business who wants to buy it, right? And then you have this sort of small segment of people called search funds.
You want to maybe explain a little bit more, if there's maybe any more color of like the types of the first category of like, why do they want to do this? Like, what's the desire?
It's the same, right? So just to compare it to some of the other options that I'm sure you're exploring, let's just compare it to private equity, okay? In both of these examples, okay, private equity's core competency at the end of the day is doing transactions, doing buy and build, roll-ups in certain spaces and plugging in operators. But it's really all mergers and acquisitions work, right? I think that it's a very common sort of
spreadsheet jockeys raise money and deploy capital.
I mean, it's sort of a caricature to be like, hey, these finance bros, these spreadsheet jockeys and Wall Street are valuing my company on something that I'm like, well, you don't even know what you're talking about because like you're not out here doing it. Like there's a disconnect. But then like a bunch of like pinstripe suit wearing, Wall Street guys roll in and like, kill the culture and like, presumably pay you the highest price, but then they change everything at the last minute and it's all deferred and they got you chained for a while. And it's that's the sort of like nasty version. And I've worked with lots of private equity firms. They're not all like that. But the thing is, the good news is if the listeners have been following this mini series, they listen to Brent Beshore and Sonny Vanderbeck, who have no
or they have no timeline. So like we're trying to introduce the people, but your caricature that the profile that you just painted, I think everybody's probably going like this.
Yeah. Brent's a great example of the opposite. Brent's about 90 minutes that way. So he's right over there.
And by the way, you're the third person from Missouri I've interviewed this week. I don't know what's going on, man. So it's maybe you are the new Silicon Valley. Yeah.
Yeah. That's exactly right. It's all Highway 70, St. Louis, Kansas City, Columbia. We got it all right. Hilarious. East Coast, West Coast is all Missouri. So, so the thing is like, you can buy an existing company. And the thing is that like, with private equity, they're raising funds, right? They're raising funds and this is what they're doing. They're deploying capital. Someone who, like me, first company I bought was a book printing company. Okay. Lots of reasons I bought it. The biggest reason was because I could get a big ass bank loan. It had a bunch of collateralized equipment. So a bank would give me a loan because the SBA wasn't doing what they're doing now back then. And I was able to jump in and basically run the company, right? And build wealth and, run a company and just be strategic and like execute things. And it was a lot of fun, right? And really, really hard. Like a lot of people kind of skim over that part.
Really,
about how hard it is.
Really hard.
It's really hard. Yeah. And, owning a book printing company during the Great Recession where, I was in my early 30s and like, doing furloughs, laying off people that had been there for a couple of decades. And, like I paid myself nothing for a full year. Right. I mean, it's just really hard. Like it gets really hard. Anyway, we can talk about that if you want. But the point is like, it's because it's a lifestyle decision. And it's like, I know that I can get a bank loan. I know that I can, acquire something that's like 10 times my net worth or more in that case. And I can build value over time through equity buildup and growing the business. Okay. So it's just a different way of being an entrepreneur than as previously explained. I think from a seller's perspective, the greatest thing that an acquisition entrepreneur brings to the table is really the continuation of the legacy. In other words, so many people are like, I want my company to mean something. My core team, I could not have put my kids through college with the profits of this business if my core team wasn't there with me for the last 20 years. Like, I don't want someone to roll in and fire them because we're doing cost cutting, right? Like, I want them to value what we've built here and the secret sauce that we have, rather than just like squeeze it, flip it, in 4 years, right? So I think the AE, right, the acquisition entrepreneur, what they really bring is the continuation of the legacy in terms of a personal investment of time, money, personal guarantees almost all the time on large sums of money. And so
and I think you hit on, and it's so important, everything you just said, Walker, because before we hit record, I was explaining kind of how our principle 1, principle 2, and principle 3 of the intentional growth principles all kind of are used as a lens to make the decisions for the seller and saying, okay, because like all I want for someone to say, okay, if someone's offering me, if there's 3 $10 million offers, all being equal, let's say actually the private equity one was $2 million more. Okay. If they say, hey, I like Walker, I believe he understands my vision and my team, and I believe him, that's the known entity. And I might be willing to accept $2 million less for that reason. And that's a choice. And it's not wrong. It's just like that, go in eyes wide open. And so I think it's super fascinating because what I always say in our training is like, because you could have 5 acquisition entrepreneurs in front of you and there's 5 different people, same price, but they might have 5 different alignments with vision and strategy and people. I don't know, but it's at least you're dealing with that conversation. And so like you said, it's not a general partner and a platform and some limited partners. And I mean, they each have their different scenarios that are tied to it.
It's been really kind of interesting, taking on the broker role as well. And the reason there's a couple of reasons I did it. One, I felt like I had gotten really good at doing private market deals, but second, it's just, I like doing deals and it's so fun to see deals that I'm not a buyer or a seller on, right?
No personal guarantees there. Like, here, go ahead. Here you go. I got all the enjoyment, but I'm not on the hook after the fact.
But it's like I did do a deal last 2 weeks ago where the buyer pulled out right at the last minute, and I wanted to be like, no, like you're making a mistake. Like I almost bought it just so I could show him like the miscalculation he was making, right? And really it was just an issue of cold feet, and he started looking at the wrong number, and like he couldn't he just couldn't get there, right? And this was a successful CEO who had an exit, and he just like, this wasn't actually what I was going to say right now, so I got a little caught. But the point is now that I'm, an M&A advisor,
you're seeing deals, and I was talking about like aligning
the
buyers and the sellers together with the vision of what's next, or what could be possible.
We ran a process on a company maybe a month ago, maybe the most popular one ever. It was a SaaS business, and we got 14 offers in about 8 days, right?
Wow.
And it's really interesting to look at these because you get, you're on all the calls and you get to meet all of the potential buyers. Most of the time, there's a few buyers that are really being considered, and the buyers that are not being considered at all, they don't even understand that, like, they're not even in the game, right? Because of, like, they don't know how to talk, or like they don't understand. It's like like in Buy Then Build, I sort of describe like the angel investor, right? That sort of kicks their feet up on the desk and is like, why should I invest in your company? And they come in, they're like, why should I buy your company? It's like, you actually have that backwards. Like, you kind of need to interview to be the CEO right now. You know what I'm saying? Like
100%. You know what it reminds me of, man? That, like, I've been in sales almost my whole life, and it's like the stupid salespeople that I'm like, you just showed up and throw up, and you put that on your funnel, and you don't know that everyone hates you. And that's a strong word, but everybody thinks you're a bumpkin or whatever, and it's like, yeah, but they think, and it's like, no, the people want to be truly understood, right? So it's probably a high degree of EQ that you're probably referring to.
Yeah. Well, it's also like, as buyers, I think that, and this is what private equity gets really right at the beginning, is the biggest thing that you can do as a buyer in any of these things is exude confidence and speed to closing. Okay.
Got to get a deal done. 30 days. Come on, Walker.
If you're like, not only do I fit in as a competent buyer, but I stand out because I'm exceptional as a buyer. And not only that, but like, I'm so interested in this thing that, like, you can have confidence that I 100% am going to close, and I'm going to close as fast as possible. And like, let me show you some letters and stuff to show you that, like, all of the cash is ready to go. Confidence and speed to closing is what gets you the deal. Okay. Private equity is extremely good at that.
Gets you to the table or gets you to the deal? What do you mean?
They're very good at getting the LOI because they know that what you need to hear is, do you have the money? And they're like, I got the money. Like, well, do you buy companies? I buy companies every week. Like, like we have a process, and we are gonna get this through in 90 days. Listen, I put 90 days in the contract. I think we're gonna get it done in like 30 to 45, but like we need 90 because I got these investors. But like, I have so much money, we can't deploy it fast enough. Like, let's keep this.
This is why I was excited to have you back on the call, because when we chat, I love your sarcastic sense of humor, man. It brings me so much joy. I just love it.
So they're really good at that because they know that's what gets the deal, right? And I think a lot of acquisition entrepreneurs, there's a little bit of a learning curve, right? Because they're like, oh wait, I can do this, and so like you'll have 14 potential buyers, and one of them will just sort of like, have a not very good phone call, throw an offer over that's 5 or 10% below asking price, and meanwhile we have like 12 offers at asking price or better, and they're like showing conviction and showing like why they're good buyers, and then all of a sudden this guy is like angry because you got the slow treatment from me.
Well, and think about that. And if I'm the seller, I'm going, it took me 20 years to build this.
That's right.
I want someone to go,
yeah,
nice work. You did it, and I respect everything you've built, and I'm willing to pay you a fair market and treat it the same way you did. I don't know if that's kind of up the alley of what you're seeing. And
no, that's right. And I also think that I think that most companies out there, okay, the 96% I said earlier, 96% of companies in the United States never reach $1 million in annual revenue. 96%. That's huge, right? So think about the large volume of businesses that really just are not
really a business.
No, I don't want to say, but I was going to say like all of those businesses that have less than $2 million in EBITDA, that's where the acquisition entrepreneur comes in. Okay. If you've got between $500,000 and $2 million in in EBITDA, SDE, adjusted EBITDA, whatever unit of measure you want to think of.
Mm-hmm.
If the second you have like 2 million in adjusted EBITDA, you're going to get private equity audience.
Mm-hmm.
But all of those companies less than that, there's either going to be niche, private equity firms like these FBA aggregators, just
Mm-hmm.
an example, or
Mm-hmm.
individuals, either other businesses or acquisition entrepreneurs.
This is going to be a wonderful bridge back to then your search fund third category, because I want to give you, I'm curious in your comments on what I'm about to say, if it fits into this transition, is I've been looking at the numbers kind of like you with stats and looking at like in the Census Bureau, like, okay, if 5.6 million of the 6 million companies are below 5 million in revenue, I look at just the math, Walker. I'm going, okay, so let's say it's a Pareto's principle and 80% of them are below, it's 80-20. So 20% of them are close to the 5 million, the rest are below. You go, okay, take 700 grand in EBITDA, seller's discretionary earnings. Let's say EBITDA. I look at the math and going, you take an SBA loan, a 10-year amortization schedule, 15% down. The math breaks almost immediately unless you're an electrician, a plumber, an HVAC technician, or the architect, or whatever the trade is, because you have to have that cash flow to service the debt. Like essentially, like you have to have the operator, the capital stack of the debt to equity kind of starts to break the lower down you go. And I remember years ago, and I don't know if you and I talked about this at conference, I'm like, there has to be different mechanisms out there to facilitate the transitions of these assets without breaking the bank where it's just debt. Does that make sense? Or like, and I think that kind of leads into the search fund area where there's
I gotcha.
And again, I'm not knocking one or the other, as I'm just trying to say, like, depending on the business model and what's going on, so there needs to be more options. Do you think that's valid, or?
No, I know what you're saying. So here's how the math kind of directionally breaks down, which is if you put 10% down on a business and you're paying like a 3 times for it, 3 times SDE, okay, plus inventory, which usually gets you, all in somewhere between 3.2 and 4x, okay, and you put 10% down, 90% debt, it comes out to about 45% of annual cash flow goes to principal and interest. Okay. To your point, and one of the things I really try to hammer home with anyone at the acquisition lab and anyone is the minute that you buy a company, we all do it. We make these mistakes and we're like, ha, I'm an owner now. This thing kicks off 700,000 and
yeah, right.
SDE is not net income, first of all. Okay. It's not actually cash flow. And they start, you start taking a big salary right out of the gate. You're like, oh dude, I'm doing it. And you're like, okay. I say, no, build cash. When you take that much debt on, what you're doing is you're saying, I'm borrowing this money and I'm going to pay it because I'm getting all this future cash, right? And so I'm giving you a big percentage of this future cash. So you need to build cash and build safety. You need to focus
and you're building equity along the time. So if you didn't do anything, you'd end up with that asset at the end, just like with real estate. I mean, it's the same equation.
That's right. And so what your point is that, like, if 45% of the seller's discretionary earnings is now going to principal and interest, and it's only 700,000 to begin with, that leaves about 350,000 in loose math. Okay, that's divided by 2. Yeah. But then you also got to pay taxes and reinvest in the business. Maybe hire that new sales rep, and it didn't work out, so that was a waste of money. And then
absolutely,
there's a lot of, and you got to pay yourself. There's just a lot of like outgoing money, so you need to So your point is, if I could get some equity on that, then it would build additional safety into the acquisition, which is exactly what private equity companies do, right? They put in between 40 and 60% equity in a deal. Why? Because they've been caught 3 times with their pants down in economic downturns. Okay, meaning too much leverage. Okay, too much.
Well, and let me a small story there. There was a gentleman that I talked to and bought a business, and it was the home services business, and bought it 10% down. And I think that this is more of like a warning story, like being diligent about this stuff, because inflation, supply chain issues, all of a sudden he had to like buy a bunch of inventory that was not in the historical performance. And then all of a sudden the labor, all of a sudden his payroll, and he's going, the whole thing went upside down. He's like, I haven't paid myself in however long. And it's like, and he's owned the company for 18 months. And it's like, doesn't mean that the idea or strategy was wrong. It was more of like the kind of the safety net is what you're talking about, because every business needs to be looked at a little bit differently.
Yeah. And so, that, like, I almost didn't release buy then build, because I was like, oh man, everyone's going to think I'm crazy, or that I'm telling, that I'm telling you, like, quit your job and go take on, like, 10 times your net worth in debt, and then I was like, God, someone's going to do it. Someone's going to run out there and do it, and they're going to go broke or whatever, but then I was like, well, look at all the books that tell you to quit your job and like run out and just start a business from scratch. And I was like, at least I feel like mine's a little more responsible.
or how to like gamble your entire future on being an Instagram influencer. I mean,
but like how many people start a home service company and don't pay themselves for 18 months? Like everybody that's ever started one, it's part of it. You know what I mean? Like it's just part of entrepreneurship.
Well, and I appreciate that context, man. Cause like what I was saying, even with you before we launched the record button is it's about information so people can make their own decisions. Right.
That's right.
Like this is a mechanism and a tool. And what I think is also interesting is, again, the kind of your three different buckets as we move on to search funds. These are, as long as someone knows who they're talking to and what the potential jigsaw puzzle options are, it doesn't matter. There's not necessarily anything that's good or bad. It's situational if people understand the options.
Yeah. So, I mean, the thing with search funds is search funds actually started right out of Cambridge, Massachusetts. Okay. At Harvard. Okay. It came out of Harvard. And, there was a professor there that historically was much more than a professor. We won't go into his very impressive background, but he was the CEO of a public company of a big company that then sold and became a Harvard professor, later moved to Stanford and sort of spread, the kind of search fund concept. But the thing is that the concept was, hey, he went to one of his, students and said, why don't you find a business to buy? And me and a bunch of my friends will basically put the money forward for you to buy it. Okay. And he was like, that sounds good. And so he went out and actually found a printing company, and he bought a printing company. And the concept, though, was here's what we're going to do. We're going to pool some money together, and we're going to fund, like you just graduate with your Harvard MBA and you're living in Boston, Massachusetts. It's expensive, right? And you've got these probably student loans or whatever. And so they were paying them, I don't know what, for that specific thing, I don't know. But, generally they're paying now like $100,000 a year just to search for that business to buy. And so a traditional search fund is just that. It's usually an MBA student or a recent MBA graduate who goes out and raises money from a group of search fund investors, okay, to cover a 24-month search period. Okay. Now, so 24 months in this example would be about 200,000. Okay. That can be a single or a partner. So that'd be 400,000. Okay. Loose math. But, and the concept is that they're going to take this 200,000 or 400,000. These investors get two things. One, they get the ability to invest the equity in the deal once that searcher finds the deal that they want to acquire. Okay. And two, they get what's called a step up. So that initial 200,000 that was raised, they get I think it's a 20 or 25% step up in, I should know that. I teach this at Old School Business. I used, but I think it's so that
loose math. Come on, Walker.
Yeah. That becomes, 240 or 250, let's just say 250,000 in equity. Okay. So you automatically get equity and you automatically get a 20% bump in your equity. Okay. From what you invested. Okay. Because you invested in the search. So a good search fund, all of the search fund investors will step up and eagerly put in, the equity piece. Okay. And so you're going to raise about, 40 to 50% of your, well, I've seen 100% equity acquisitions with no debt in search funds. And so the thing is the concept is they're bringing in that equity, that patient capital, and then they're minimizing the debt piece. And as a result, because they're sort of getting that bump, that lift of equity, it's also taking them above the sort of limits of the kind of like SBA financing, which would be the most common, okay, in this space. And so the average search fund acquisition is about $13 million, right? So a little bit bigger than, you're sort of like, let's just say sub $10 million acquisition entrepreneur acquisition.
So then, and that's super, super clear and helpful. I appreciate that very much. And then from the MBA student, talk about from their perspective and like how, because that makes sense from the investor why they would want to do that, especially over that. And that's why I think about this mechanism fits in the market because people need yield. So these investors are looking for different ways to get into these companies without having to operate them, right? Which makes sense. And so then from that searcher, like how you weren't talking about from their angle, right? From the bump up in equity, or is that what you were talking about?
That's what the investor gets.
Yeah. So then, so speak to the person that's out there. Like if it was you and me, or like the MBA student going out there and finding these companies, why do that? Why? What's their motive behind this?
Yeah. Well, I mean, their motive is, I think, twofold. First, I think that, when you are coming out of business school, okay, you still need a little bit more experience, before you're ready to start like gunslinging and doing it yourself. And you probably have no money. Okay. Right. But a lot of search funds came out of Harvard and Stanford. Right. And then they've expanded to MIT, University of Chicago. I mean, these are the best, Yale. These are the best schools in the world. Okay.
Mm-hmm.
And they're the ones capitalizing on it because they're going, oh my God, are you seeing this opportunity? Like, this is the hugest. Well, these are the smartest people in the world going, oh my God.
Yeah,
don't
right.
build, right? This is what's happening. And so, and they're saying like, well, we need operators. Like, where are we going to get operators? And they're like, oh, we run Harvard Business School. Like, this is amazing. Like,
ding, 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 ding. Yeah. Conveyor belt of operators and money. That's called the definition of a flywheel. They're using their own endowments too.
Yeah,
like,
exactly,
just close the loop.
Yeah. And so you get a lot of, So anyway, and by the way, this is a really interesting component from the investor perspective. If you have people that are interested in being investors, a big part of the 20% step up just of the initial search is that 20% up kind of, if you get it over, say, a portfolio of 10 of them, it sort of covers the portfolio game of like those, 1 to 3 losers that you're going to have.
Mm-hmm.
That step up alone on the winners is the thing that actually nets you out on the loss, and then the gains of the big winners is where
that's awesome.
Profit.
That's awesome.
That's kind of the thought behind it. There's another thought behind it, but I'll spare you the academic. So from the searcher's perspective, they want, tell you what, I'm going to borrow from Brian O'Connor, who teaches entrepreneurship through acquisition at the University of Chicago and started Next Gen Partners, which, by the way, is a single sponsor model, which there's different models of search funds we can unpack if you're interested.
Okay. Yeah, let's do it.
He said it best when I asked him a version of this question. And he said, okay, in a normal kind of, business situation, you have like, the horse and the jockey, right?
Mm-hmm.
Meaning the business and the entrepreneur. Okay.
Mm-hmm.
And then he said, in search funds, you really pay attention to 2 other things, which is number 3, the track, meaning the industry that you're in. Okay.
Well,
and number 4, and this was the big one, was the coach. Okay. The coach of the jockey, the coach of the horse, and the coach is presumably the search fund investors who then become your board of directors.
Mm-hmm.
So this is a very formal situation where, you're acquiring a business for $13 million. You have not had a post MBA job, most likely. Okay. You're bringing in a bunch of people in your community that are investing equity and time to help you succeed. And then you're the ones really getting, dropped in there, and you're getting, I mean, if you compare this to, the acquisition entrepreneurs that we just talked about, where you're buying like 80 to 100% of the company, you're buying, all of it usually. And you get it all. In this situation, these guys, they're usually getting about 6% of the company at closing, and based on their performance, they can earn up to 20.
Mm-hmm.
Okay, so it's much more of like a private equity operator kind of compensation.
Well, I love like even comparing those. Like, so if you think about it, like the first category of the corporate executive or someone that's buying, however they're getting that SBA loan, they have to have a certain amount of wealth to personally guarantee a portion of the. First of all, have somehow wrangle a few $100,000 down, and then personal guarantee enough stuff, and they have operating experience. Versus, the MBA student, like you said. First of all, I don't know how much those loans are, but like you're not just going to parachute in and get a $125,000 job with no experience. So my guess is the personal income limitations are already an issue, but then how do you get equity? I mean, everybody's job pretty much is trying to figure out how do we get equity in an asset that grows. And that's a way to, kind of thread the needle of those two.
That's great. By the way, I think the average starting salary of a Harvard MBA is like 150 to 175 right now. So just to put it out there. Now I think that
I was short.
Well, if you run a search fund, I think it's lower. I think it's like maybe 100. Okay. But the concept is, you're earning up to 20, sometimes 24% on a single operator, search fund. And so the concept is let's say I buy a $13 million company. Okay. And I spend 5 years running it and I grow it and we have an exit at 15 million. Okay. The math's wrong because there's some debt in there and whatnot, but I just made, $2 million, $2.5 million in 5 years. Right. I mean,
they're growing the asset. Yeah.
Plus I got paid, 100,000 along the way. Like, it's great.
And let's go back to the alternative is take no job, do a startup, gamble, 10 years, no pay, no nothing.
or go get a job,
save,
go get a job
and save.
You're making $150,000 a year, which is amazing money, right? And I think that's the hard part for that category of people. It's like, well, wait, I can make $150 a year, and at least get my sea legs under me, But 5 years later, you saved 20% of your after-tax income for 5 years, and your buddy just pocketed $2.5 million. I mean.
And it's real, and I think that's so. You were talking about independent sponsors. What are some of the?
So
is there a couple different options?
What we just talked about has now been sort of tagged as a traditional search fund. Okay, then you've got a single sponsor search fund. You've got an independent sponsor, and you've got a self-funded. Okay, so the traditional we covered. The single sponsor is the one that says, hey, in a traditional search fund, you have these two raises. Right. So the first you have to raise money for, will you help me, and then the second is once you get the deal, you have to go raise money around, hey, now I got the deal. And so some of your, angel type investor, search fund investors might fall off and they don't really like that deal. And now you got to go run and get the money. And in the meantime, you're trying to get the business under LOI and your investors are falling out. Now your sellers, what are you doing? So there's a lot of drawbacks to trying to get this done if you don't get the right investors at the beginning. Single sponsor search funds basically say, Pacific Lake, I think is the sort of first, and they're, by the way, started by Jim Southern, who was the first ever search fund entrepreneur. Next Gen Partners was another one I just mentioned, but Search Fund Accelerator is a bunch of them. But the point is they say, look, we want to fund your entire search, we want to fund your acquisition, and we're going to bring all these people in. So we now have a CRM. So every year we bring in a cohort and we have this CRM that basically we're doing proprietary outreach to all of these potential sellers. And, if a traditional search fund builds the wheel from scratch, and then 4 years later, that seller calls and says, hey, I'm ready to sell to you. They're like, dude, I bought a company 3 years ago. I'm knee deep in book printing. I can't buy your company right now.
Yeah. Right. Yep.
But if you call one of these other places, they're like, oh, well, Walker's gone, but Ryan's here now. He's in the new cohort. We're going to sell. Ryan wants to buy your company, right? And they're like, oh, who's Ryan? That sounds good, right? So there's
Ryan have a check. No.
Yeah. So the sales part is sort of like, hey, you don't have to raise money really at all. You just have to sort of get in. And then number two, we have all this education that we educate you on. And then number three, we have all this proprietary deal flow that is on this flywheel. The downside of a single sponsor, of course, is going to be that, they basically get the keys to the kingdom. And if they don't like your deal that you want to buy, now you got to go rogue and
so that's super helpful, man. And honestly, you shed some light on even my understanding of this. Cause I was under the kind of just probably on the search fund, I've kind of been scratching the first kind of chunk of understanding of it. But I always thought it was the person that was paying for the salary and then sponsoring the deal. So what you just described is actually what I kind of attributed to that. So that was very helpful because I'm going back and now it's even making more sense when you're talking about the salary and then the step up in the equity because it's a separate investor. Then that's potentially that makes a shitload more sense.
Yeah. Can we say that S word on this show? I didn't know.
Yes. Apologize for the audience. They know that I like to. I try to keep it as PG as I can.
No. Yeah. I'm. There's effort here, not dropping F bombs. I get very excited. But so the last two are sort of like independent sponsors and self-funded. So independent sponsors. What's interesting is they did a survey at. Harvard keeps coming up in this call, but they did a survey at Harvard and said okay, 2 years ago, what's the number one most desired career job for these current MBAs, and independent sponsor was the number one selection.
Wow.
And I want to be very clear here. Saying that you want to be an independent sponsor as your job is the equivalent of saying, my career plan is to move to Hollywood and be an A-list actor.
Right.
Okay?
I was like, you're just jumping a couple steps there.
Yeah, exactly. It's like an end goal of like a lot of things that happen along the way. Okay. Now it's probably easier.
I want to be Steve Schwartzman, the CEO of Blackstone, right? Like, who doesn't, right?
Yeah. Do you talk about independent sponsors in other parts of this?
You know what? Like because in our training in Principle 3 in the 5 exit options, we talk about acquisition entrepreneur. But like I said, that it's probably like 40% of what we're talking about now. So this is super helpful. This is actually going to end up going in the training underneath that category because this is very helpful.
So an independent sponsor, there's another word for an independent sponsor, and that is fundless sponsor, meaning they don't have any money. So it's a private equity firm. Seriously, it's a private equity firm that has no cash. Okay, they didn't raise a
hopes
fund.
And dreams, Walker. Hopes and dreams.
They didn't raise a fund. They basically just said, "Hey, we want to raise on a per deal basis." Okay. Mm-hmm. Now the other thing is that the buyers of it are more interested in operating a fund than they are in operating it. So usually, what happens is they end up getting equity from private equity firms who take the equity piece. Okay, and then you get the debt piece from a lender directly. Okay, so you're kind of becoming the fund yourself, right, on a per deal basis. But then two things also usually
and
happen.
The deal is the mechanism to the deal consummates all of that stuff. But it is the deal pretty much secondary to the structure that they're trying to get at? Is that what you're kind of saying?
It's sort of like, I'm sure it's very common for you to hear at some point in your life, like, oh, just find the deal and then you'll get the money. Right?
Yep.
It's kind of that. It's sort of saying like as long as I can get an exclusive on this deal, the deal becomes mine, and then I get to shop it. Right?
Yep.
And then
does that have a lot to do with, Walker? Like I've even watched over the last 5 years, brokers, and even like the middle market M&A advisory firms. I mean, you used to be able to just like click and ask for information and sign NDAs, but now it's like, personal financial statements, tax returns. I don't know if it's so many people sort of flooding the market of just wasting people's time for this. Is this part of that, or is that maybe just not as correlated?
I mean, like I don't know. I mean, I will say that in my broker role, well, in my business operating role, there's so much that just time wasted. I mean, right? But then like in brokerage, it's the same thing. And so I think that I don't have an answer to that, Ryan. I don't know.
No. I was just maybe I was
and I think
connecting
it's also,
two dots.
Well, I think what's going on here is that like the private capital markets are opaque. They're fragmented. There's no best practices, right? I mean, no one knows what they're doing, right? I often describe it almost as like cyclists on the road. Cars don't like cyclists. They think they should be on the sidewalk, I guess, with the people walking. And cyclists don't like cars. They're both moving vehicles on the road, but because bicycles aren't actually on the driver test, neither the cyclist nor the driver knows how they're supposed to behave. Okay? The private capital markets are exactly the same way. No one knows what they're supposed to do. Like, it's unregulated. Imagine if anyone you knew or have ever met could just become a real estate agent without getting a license. They could just like become one. That's business brokerage. Okay,
isn't that crazy,
it's completely unregulated. There's nothing. Okay, some states require a real estate license because they're like, I don't know, we need something, right?
And you know what's so crazy, Walker? Like, and I just heard this recently. I was talking to a buddy of mine who's an investment banker, and in her training, and I have to go and update it because I made it 3 years ago, is like, the difference between brokers and investment bankers is investment bankers were security licensed, so they were regulated by FINRA and the SEC, so they could do stock sales and all these more complicated stuff. And my buddy was saying like, no, like brokers can now do some of that stuff based on the new regulations. I'm like, whoa, we got even more open.
Okay,
which is
I can actually talk about. I used to be licensed by the SEC as well. Like, so I had the Series 7 and all that stuff. We can talk about this. But maybe it feels a little off topic. Do you want to talk?
I mean, I think it's just super fast. I mean,
Okay. So here's what's going on is basically once so you've got asset sales and stock sales, right? And once you have a stock sale, it becomes a regulated market. So if you're going to raise capital as a startup, right, you need to go file with the SEC and do your your A round and all the rest of it, and then everyone needs to be accredited, and you're responsible to make sure everyone's accredited. That's all the regulated stuff because it's an equity transaction,
right?
Okay. And the only reason why, if I'm selling like a $2 million business and it becomes a stock sale, I now need to be licensed if I'm if I'm negotiating or brokering the deal. Okay. In our contracts, what happens is if the deal, I'm sure there's a right way for me legally to say this. So if there's any attorneys,
just the spirit.
Yeah,
we're not attorneys or CPAs, man.
Legal way. But the deal is that basically it's like, oh, okay, I now can no longer negotiate the deal, and the fee that the seller is paying the brokerage becomes a marketing fee, and it becomes a flat fee that has nothing to do with the percentage of the purchase
That's
price.
what I do recall now, because it had to do with you get around it with not tying it to the exact percentage
So the real difference to me today in terms of a business broker or an M&A advisor and an investment banker, okay, is that an investment banker is able to raise money, okay, around like a minority investment around a company, okay, and number two, they can take you public, which is basically the same thing. We're raising money.
Yeah. It's just all to do with equities and raising money. Yep.
Yeah, but if it's just a transaction, it doesn't really matter. And the thing is that as someone that used to be regulated, you have to be affiliated with a broker dealer that's affiliated with FINRA under the SEC, and just the sheer overhead expense of
regulation and all the compliance and stuff like that. Oh my God, yeah.
I mean, I would have SEC agents in my office here, here, looking in my file cabinets, and at my house where I have another, I've got like a desk shoved back into basically a closet. I mean, it's nuts, and it just becomes so expensive that if you're in the sub $25 million market, it's unaffordable. No one would be able to operate because you would just go broke. Like the SEC would get all the money. So it's not transferable. It's not relevant information. Coming from someone who used to be regulated, right?
Right, and all that makes sense. And it was a slight digression, but I actually just had Peter Learman from Axial on the podcast. We split the series and the mini series in a couple of chunks. Peter's awesome, and we actually did an update on the M&A advisory fee survey that they just did. So this was a nice little tack onto that, but kind of bring us full circle back to I was bringing it up because of the amount of NDAs and the personal financial statements and all that stuff that brokers and investment bankers are requiring. And I think the whole point of this is business owners, Walker, that come through our training that I'm talking to and speaking in front of all the time, don't know the difference of any of this stuff. They think it's either internal transfer, strategic, or private equity. And there's so many flavors. So what you're doing is you're giving people the information to say, oh, Walker has no money. He's a fundless sponsor versus someone that raised some money. They ask the questions so that way we can figure out, do we trust each other? And is there a transaction available here?
Well, I also think that frankly, brokers are terrible. Almost all of them are just terrible. And I'm so sorry to say that. I mean, there's really
you're one, at least I've said variations of that comment, but there's always there's a couple the top cream of the crop.
Yeah, by and large, they're bad. And the thing is they don't understand what we're talking about right now. They the thing is when I talk to someone, I'm like, okay, well, I can figure out pretty quickly what's happening. And I'm like, okay, so if you're a search fund, I'm not going to lock you out. Okay, you're not locked out. I just need to understand where we are, and I think that this is probably a big part of it. So the last one is a self-funded searcher. Okay, let me explain this for a minute. A self-funded searcher is someone who basically is an acquisition entrepreneur, but was introduced to the topic through their business school program. So in other words, I have no money. I'm not part of a single sponsor search fund, and I'm trying to find a business to fund and operate. Okay. Now, what they do is they typically will, come up with. I always joke with my chief of staff that they come up with the name like Beaver Lake Capital. And they, you know what I mean? Like, it's just like they come up with something, and it's always like it's like it sounds like a private.
So a nature, it's like a statue or a street or something.
There's literally like a website called like Name My Private Equity Firm, and it just like is a rolling, like you hit go, and it's like and it rolls, and it's got like an animal and like a
sturdy oak.
Yeah, Eagle Mountain, or like whatever it is, like whatever it is. So yeah, like Beaver River, is the one I always joke about. But anyway, so because I grew up on Beaver Drive, Brian. Let's. I mean, don't
not a river walker, not legit.
So the point is like they have these websites, and it makes them look like, oh, like I'm a funded, like we've got a thing, and I'm looking to buy businesses. And then the other thing is that search funds are very there's this little element in there that when they raise money from these investors for a traditional search fund, okay, Brian, what did those investors just buy?
So you cut off for a second. Say it again.
Yeah. So if you are an entrepreneur that's going to run a traditional search fund, and you raise money from like a dozen search funds, investors to get that 200,000 so you can search for 2 years, what did those investors just buy?
The future, the potential to have equity in something.
Yes, they bought your time. Okay, and you want to know what they want? They don't want you to just go out and call all the brokers and look at the broker listings. They are really emphasizing proprietary deal flow because they want you to go out and find. They want you to run that hamster.
Describe proprietary deal flow. I've covered that topic. But explain proprietary deal flow because it is just a fancy name for something that makes a lot of common sense.
It's a fancy name for off-market deal, right? I mean, basically, you either go to the M&A advisor, or you as an individual reach out to
go to the trade show and shake hands with Walker at the Printing Book Conference Trade Association, right?
That's right.
Go to the bar, Walker. Go drink some and go find a deal.
Exactly. It's like there's no broker. You're not on the market. It's just like, hey, like, look, I don't want to be too bold, but like, would you sell me your company? I'm looking for something to buy. Like, no's an okay answer, but like, you open to this or what? That's a proprietary deal, okay? And so the thing is these search fund investors and in particular really push a proprietary deal flow because they're coming from the middle market where it's crowded with institutional buyers. Okay. And it's all about, it's like, dude, how do we get upstream? How do we get proprietary deal flow? So it's tons of letters. It's tons of outgoing, and my curriculum designer for the acquisition lab is joking with me. And she's like, I think I'm on one of these lists because they always call me. They call me, like, she goes, every month I get some MBA student. They're calling me. They're asking for my husband for some reason. She's like, I don't know why. I guess they think he owns the company. They ask for my husband, and then they want to buy the company, and they're, whatever, and they're just like, dude, like, no. But the thing is like, is they really emphasize this proprietary deal flow, and so, but the thing is that like the searchers pretty quickly start their search by reaching out to brokers, then they turn to proprietary deal flow because they think that's where the magic is hiding. In my opinion, it's not. Okay, and you're going to spend 90 to 99% of your time doing proprietary work for your investors, but you're really going to get the deal through a broker. That's every conversation.
Yeah, and honestly, just to completely validate, exclamation point, highlight underneath that, is that the number one reason this show and my company exists is because no one really understands this shit. And so then the proprietary deal flow is going to be meeting with 17 walkers who think their company's worth 10 million and it's doing 50 grand in SDE. And it's like, well, how much is my company worth? It's weird. It's exactly your retirement number. And so
that's right. That's right. Yeah, that's right. But so to answer your question about like, why are brokers getting more intense? Here's my thing. I think it's probably because the market is growing up a little bit. It's going from the Wild West to getting on the map. Okay. And number two, you have all of these like self-funded searchers that are just blasting out, like everyone in the world saying like, hey, like I just bought this CRM and I want to look at all of your deals. And then the brokers are like, wait a minute. I thought we were working with like a funded dude, and it turns out like you have no money, and now I look like a moron to my seller because I don't know what I'm doing. What's a search fund? And then like, so now they're like, okay, well here, let's boom, boom, boom. I would imagine it's probably reacting.
That makes a bunch of sense.
Getting humbled by people that want to make cash. Yeah.
Dude, this has been so much fun, and I was I was super excited because like this, and to get, this whole world is like these like I said at the beginning, this has all exploded in the last 5 years. I mean, people,
Oh yeah.
like the category created, and then look at the flavors you just described that have happened in the last 4 or 5 years.
I would say, I would go on a limb and say it exploded in the last 4 years when By Then both came out.
And the hardcover release is out. Or one, yes. What I have 2 questions. One is, you tell everybody where to find you, the book, reviews, buy it, whatever you want. Go for it.
Sure. So the week this is launching, we are. Thank you, Ryan, for that. We're launching the hardcover edition, which is just super fun. Something I always wanted to do. And to celebrate, in a weird twist of fate, we're making the ebook 99 cents for 1 week.
And we're having the hardcover launch, but you can go ahead and get your digital version. Like I said, your sarcastic sense of humor, man. This is like it's mine. Well, I love it.
I kind of did it on purpose, because it's sort of like when I launched the book, the publisher was like, "Well, listen, dude, most books only sell it's something like most books sell like maybe 200 copies during their entire lifetime." Did you know that?
Oh, nice. I feel like I heard that stat, because there was some other stat about musicians and like how many downloaded songs, and it's it's the Pareto principle. It's like the 5% get all the So, and let me guess, yours was not that.
Well. So he said, like, look, if your book's successful, feel free to come back and let's do a hardcover launch. And so I've been like 41 months consecutive bestseller on Amazon. I've been, it's been adopted into 6 universities, and we just sold 50,000 copies. And I'm like, dude, like it's time. And he's like, okay. And then I was like, okay, I want to discount it for launch week. And he goes, okay. And he showed me the numbers, and I was like, oh God, like I'm going to have to like subsidize, like it's really expensive to make hardcovers. And I knew this, right? But I didn't understand how expensive they were.
Did you own a book publishing company?
I did. Yeah.
Sorry to like loop that back in there.
Yeah, I know. So the obvious thing was like, well, okay, let's launch it, because like I want it. Gosh darn it! But secondly, it's sort of my acceptance into like real authors category, right? But then like I was like, well, then I want to discount the ebook so everyone can just buy it for cheap.
I love it, man. And it's, I remember, I absolutely remember I was on a Mexico vacation with my wife, and I bet you I highlighted the whole damn book. It was just like, I loved it, man. And I truly sent it out to specifically a lot of people around our age, because I'm like, guys and gals, or whoever, like if you want to truly make wealth, I mean, like you can go work for someone. It's something that I think everybody needs to move and push up forward, because like there's not enough buyers. Right. I mean, like you and I were talking about that. We need more people that are younger that are saying, hey, I'm willing to do this for the whole economy.
And what's really funny is that, like, I think it's like 1% of all MBA students are turning into this search fund deal of the MBA programs that have introduced it. Okay. Mm-hmm. And most MBA students, even now, are getting introduced to this concept in their last semester. And they're going the second half of their last semester. And they're like, oh my gosh. And then like 1% of them are converting. And if you take all the MBA students nationwide and you take 1% and convert them into search funds, it outranks the number of private equity firms in our country.
Yeah, because what is it, like 7,000 or 8,000 private equity firms?
Sure.
Or something?
I did a presentation a year ago, and I ran the numbers. I'm sorry, but it's really interesting to sort of see, like, wow, like as this rolls out and gets adopted, the number of buyers that we need it's just kind of interesting. It's going to be much larger than private equity by sheer volume.
That's awesome, dude. Right? And before we wrap up here to it, because I have 2 last questions. One is that the cohort that I don't know, because people that are like searching and looking for companies too end up tuning into this quite a bit too. So I don't know if you want to give a little bit of an overview of your cohort.
Oh, sure.
Cohort that you got?
Yeah, I mean, let me explain it like this. Like I want to be really clear about this, but it's sort of like, people read Buy Then Build. I went on with my life. I'm running my companies. I'm doing some brokering work. People started coming up to me and saying like, hey, would you help me like find and buy a business? And I'm like, no, dude, like that's like, oh, no way. Like that is so hard. Like I was like, I'm going to have to charge you like $125,000 a year to work with you. I don't know if you're actually going to buy anything. Right. So I was like, okay, how do I like unpack this? Like, how do I help people actually do it? And, we anchored in world-class education, which I then went and taught at business schools, and then came back and iterated, made it better for individuals. we have a vetted community. So 25% of applicants are accepted. We've got resources, tools, and then we have an excessive amount of group coaching and consulting. So we created the acquisition lab, and that's what we run.
That's awesome, man. And hopefully, people that are listening, whether they're looking to join something like that because they want to buy, or they're looking to find a quality person that they gravitate towards this type of an exit, I think it's something that's super awesome, man. Last question for you.
Yeah.
The word intentional, it's the name of the podcast. I love hearing what people's definition is. I don't know if you knew that I asked people this, but I love to know what their definition of the word intention is. I've now got Walker, it's probably 100 and some people's definition of this word.
Wow.
And I love it. And so I know I didn't prep you with this, but do you know, or what does the word intentional mean for you?
Okay. The word intent is actually included in letter of intent, which is the LOI. And what it means in that context is that based on what you are presenting to me and assuming that is true, I am interested in acquiring these assets, and my intention is to acquire these assets for this many dollars at these terms, right?
I love it. I love it, man. That's awesome. I love it.
Yeah. In other words, it would. I think I would base it on that. It would say, based on the information that I have right now, my intention is to execute this in the near future, and so we're walking that path together.
Ooh, that's good, man, dude. Thank you so much for coming back on the show, Walker. I love hanging out with you.
Yeah, Ryan, this has been a lot of fun.